Oh, I didn't expect you guys to be here, but I'm kind of glad you guys are. Um, Perfect time to have I guess, a good discussion about something that you may or may not need in your life. But let's see if we can elucidate that fact and or opinion to see if we can even help you in the first place. So, whole life insurance. What does that even mean? Like, what even is that? I guess to maybe understand what it is and how it may be able to help someone like you got to understand a little bit more about where it came from and the root of what it actually is. So, bear with me really quickly. The first life insurance company in the world, quote unquote, was Amicable Society for Perpetual Assurance Office, which was founded in London in 1706 by William Talbot and Sir Thomas Allen. The company paid the wives and children of deceased members an equal amount at the end of each year. However, the idea of life insurance can be traced back to the ancient Rome, where burial clubs were established to cover the funeral costs of members and help their survivors financially. The concept was started by a Roman military general, Gaius Marius, who proposed that soldiers who died in battle would have their funeral expenses paid for by their fellow soldiers. The idea eventually spread to the general population of ancient Rome and later evolved into a desire to provide financial security for the family of those who died in battle. In the United States, the first life insurance entity was the Presbyterian Ministers Fund, which was established in 1759 by the Presbyterian Synod of Philadelphia. The fund was created to provide life insurance to the widows and orphans of deceased Presbyterian ministers. So now that we understand a little bit of the ancient history of it, let's understand a little bit more of the contemporary history of it. So whole life insurance was very popular around the 1940s all the way up until the 1980s. And that was because most people wanted a little bit of more security for themselves and for their family. As you can kind of understand, in the 1940s, America was kind of going through a lot of change and a lot of turmoil, or different things were being established, different solutions for the people were being brought into fruition. And so in the 1940s, you could kind of understand that Americans kind of wanted something that was going to give them more security. All the way up until the 1980s, whole life was the primary source of, I guess, life insurance that most people actually sought out for themselves. Now, in the 1980s, what began to start happening was, again, a whole bunch of different, health crises and different things are happening with the mortgage rates for people. Different things were happening with a few different things that were happening in the market as well. And so in the 1980s, people, I guess, no longer want to look at whole life as just the main solution for themselves and for their family, the main investment solution as well. But they want to look at maybe switching to a term policy or switching to a what's considered a universal life policy, because universal life policies started being very popular in the 1980s. So for someone who may have an inquiring mind like you, there are two specific types, or two main types of whole life coverage. You have regular whole life. Now, regular whole life, it comes with, the other one, which is final expense. Like, they both comes with the same different riders that can be attached to it, but one is, this regular whole life is more for, I want to say, younger folks. Not just younger folks, but it's more specifically for people who are, let's say, in their 20s, all the way to maybe their 55s, and people who don't have that many comorbidities that they currently have. Now, final expense, it's also considered a whole life insurance policy. However, final expense is specifically curated to have a lower death benefit and also a lower monthly premium that's given specifically to seniors predominantly. Now, in the regular whole life, which is quote unquote regular whole life, you have dividends, you have stock options. Well, some of them you have stock options. Some of them you have the ability to have different types of funding options to, I guess, give you as the client that may want a little bit more options. Now, for final expense, again, as I was saying, final expense, you can do some of those things as well, but most final expense policies aren't necessarily going to be curated to, I guess, give you that much growth. It will give you growth because it's a whole life policy, and it comes with the dividends. It comes with the cash growth of about 4%. That's what I think the going rate for most insurance companies still is. So it comes with all of that. It's just, what's the formula that you're currently looking for and what you actually want for yourself. So regular versus final expense. Keep it simply put, final expense is usually what's considered burial insurance. Regular whole life insurance is what's considered insurance for life slash investing. Well, mostly for life. Okay? So as we just figured out, whole life, based on what the name actually represents, if my pen marker would actually work, whole life is what's considered permanent insurance. Now, I might not be the best speller right here, so I'm just going to abbreviate it, okay? Permanent insurance. Typically, it lasts for most folks up to about 120 years old. Now, if you live to 121, God bless. Let me know all your secrets because I'm trying to live a long life too. But for most folks, they might not see 120. So if you're there, please let me know your secrets. So for most folks, they're gonna pretty much pass away and move on by 120 years old. Whether it's a final expense or it's a regular term policy, some final expense, some, not all of them, some of them go to age 100, but I believe most of them still go to age 120 like a regular whole life insurance policy does. Now, again, talk with your agent, whether it's me or whether it's someone in your family, whoever, I guess maybe put you in the policy that you're in and look at it and see if it's actually something that you want to keep, or if you want to maybe switch to a regular. Yeah, so whether it's a regular whole life or a final expense whole life, if you'd like us to do a policy review for your policy, feel free to, I guess, comment down below, or depending on what platform you're seeing this on, you might be able to personal or direct message me. And I guess one of my doppelgangers or clones should be able to reach out to you, okay? All right. So it is permanent insurance. It lasts all the way typically to 120 years old. Now, in it being permanent insurance, another, I guess, beautiful wrinkle that it has, why most people back in the 1940s through the 1980s looked at whole life insurance as something they wanted to do for themselves, is because it adds something called cash value. Now, I'm pretty sure most of you are aware of Walt Disney. Some of you are aware of, I guess, the Rockefellers, JCPenney, hopefully, Ray Kroc, McDonald's. Hopefully you guys are. But the reason why I'm telling you guys that is because all those, financial barriers of the past, other than being extremely wealthy, one thing that, whether it's either their fathers or their parents or themselves did for themselves, is they established a whole life policy, and they used the cash value in some way to help them fund their business. And the reason why it was so popular, back in the days in 1940s to 1980s, because a lot of folks didn't just use it as life insurance, they used it as a way to fund their business. They used it as a way to, I guess, build cash value for themselves in kind of like an investment portfolio type of way. Now, stocks and bonds and all those things were there as well. However, a lot of folks thought about it in the way they thought about certain things back then is like, if I can get life insurance and investments and get 6% back on my money, whether it's with the dividends plus the 4% that the insurance company gives you, I can get almost 6% back with my money. I would just do that. It's simple. I'm just dealing with one guy instead of dealing with a whole plethora of people to build my stock portfolio. However, this main point of what I'm trying to say here is whole life insurance comes with cash value. That cash value comes in usually, I don't know, your policy. So if you look at your policy and it's a little bit less, you might have to talk with your agent. But usually it comes about 4% interest per year plus 2% dividend. Now the dividend in whole life policies, I don't know if I spelled that right. Don't judge me if I did. If I didn't. The dividend in whole life policies is what's considered voluntary. So The insurance company doesn't necessarily have to give it to you. However, I'm gonna let you in on a little secret. Although they don't have to do it, for the last 120 years, insurance companies have given out dividends to their policyholders. Just saying. So dividends is usually about 2%, and the cash value that it has is about 4%. And another beautiful part of whole life coverage is it remains what's considered level in financial terms or in insurance terms. Now, it being leveled, what that means is it's not a decreasing term or a decreasing death benefit type of coverage. There's certain policies nowadays that are being sold that there's one day where you sign up for, say, a 200,000 death benefit policy, and then in the next 10 years, you realize that your death benefit has gone all the way down to like 50,000. Now, I'm not going to say the names of those policies, whatever they are, but some people do get that. So it's either increasing or decreasing death benefit type of coverage. That's not what whole life is. Whether it's a regular whole life policy or final expense whole life policy, it's level. That means the death benefit is going to stay level. If you sign up for back in 1985 for a $50,000 death benefit, that death benefit is going to stay the same. Now, what's not going to stay the same is your cash value. Your cash value is going to grow, so your family will have the opportunity to dip into that cash value. Now, I'm not going to dive real deep into what the cash value might actually do for your family. That's going to be in another video. Again, depending on where you are, what platform you're looking on, that video may be around here somewhere, maybe in the suggestions over here or something. I don't know, but it should be there somewhere. So it will remain level for you. So the death benefit that you signed up for, that the agent told you that you'd have, you should be getting. Okay, so it's a 50,000, 100,000, 150,000, 200,000, 500,000, whatever it is, whatever death benefit that you sign up for, should be yours. Okay. With that being said, do you think I covered the basics of what a whole life policy is? If I did, or if I didn't, or you may want some more information about this, again, feel free to go down in the comment section and raise your hand or say, hey, Josh, can I get some more info? And we should be able to possibly set up a free, policy review, or if you want to look at maybe what whole life insurance could do for you, for your family, if you've never heard about it before, feel free to comment and say, hey, I'm looking for some help, or I'm interested, or personally message me if you want. All right? So that being said, you guys have a beautiful and blessed rest of your day.